Welcome back, everyone, with absolute high energy for the grand finale of our Explainer series. Over our last 3 sessions, we've pieced together a really solid structural blueprint for a modern software business. Just a quick reminder before we jump in. We are operating exclusively within the US market here and speaking strictly in US dollars. You've laid all the groundwork, and today is the day we bring the whole thing together.
Okay, let's dive right into this. If you remember back in part 3, we were really in the trenches, right? We were reinforcing our infrastructure and building those defensive moats to protect ourselves against platform risk. But a fortress doesn't actually go anywhere on its own. So it's finally time to transition out of the construction zone and slide into the driver's seat. Today is all about looking at the dashboard of this amazing SaaS machine we've built and figuring out exactly how to accelerate.
So let's look at our next section, the vital signs, covering the metrics that actually matter.
If you log into literally any analytics tool today, you are immediately bombarded with a million flashing numbers. It's like a slot machine. Well, we're stripping all that noise away to focus purely on monthly recurring revenue, or MRR. You already know MRR is the absolute heartbeat of your operation. We're talking about that predictable, active subscription cash that keeps rolling in month after month. We aren't looking at one-off sales here or random consulting fees. We only care about the pure, recurring US dollar lifeblood that actually funds your future expansion.
But here's the catch. You cannot maintain a strong heartbeat if your business's immune system is shot. And that brings us to basic retention. 35% is the absolute minimum baseline target you must hit just to survive. Seriously, if you dip below 35%, your system is failing. You are bleeding out customers way faster than you can realistically acquire new ones. So please, don't look at this as some sort of aspirational goal. 35% is the floor.
Now instantly contrast that bare minimum survival floor with this, 93% or higher. Wow, this is what it looks like when you transition from merely surviving to completely dominating. The genuinely great elite SaaS companies in the US push their retention rates up to 93% and beyond. Why? Because their product has become fundamentally indispensable to their users' daily workflows. Honestly, this is the penthouse suite of customer loyalty.
Now, what's really interesting about this slide is that we see a fundamental shift in how we think about growth. We're moving away from just basic retention over to net dollar retention, or NDR. Think of it like this. If basic retention is your immune system keeping you alive, NDR is pure muscle growth. Basic retention just asks, hey, did the customer stay? But NDR asks a much, much more powerful question. Are the customers who stayed actually paying us more money over time?
Take a look at this. Notice how a baseline of 100% basically means your upgrades are perfectly canceling out your cancellations, so your revenue is totally flat. But those best-in-class companies, they settle into this incredibly healthy NDR zone between 105 and 115%. To put that into perspective, this means a business could literally fire its entire marketing team today, not add a single new logo all year, and its total revenue would still organically grow by up to 15%. Guys, that is the absolute magic of negative churn.
And this brilliantly illustrates why we're moving to our final section, the master blueprint, taking a look at our series recap.
Zooming all the way out from those intricate vital signs on the dashboard, let's take a look at the completed master blueprint we've actually drawn together over this entire series. Back on day 1, we tackled the landscape, forcing a really tough decision between a lean micro SaaS or that aggressive venture-backed path. By week 2, we structured our USD pricing tiers. Month 3 was all about fiercely mitigating platform risk. And finally, spanning year 1, we established our vital signs to chase down that glorious 115% NDR. So, what happens today? You understand the landscape, you know the pricing, you see the risks. But I'm going to give you the hard truth right now. You can memorize every single metric, and you can watch 100 of these explainers, but it is utterly useless if you stay trapped in tutorial hell, right? It is officially time to step out of learning mode and firmly into doing mode.
To give this whole journey some real, tangible closure, here is your one highly concrete action step for today. Step 1, close the roadmap. Step 2, run your first 10 customer interviews. Seriously, do not write another line of code today. Don't sit there tweaking the hex colors on your logo. Get 10 actual human beings in your target market on a call and test your assumptions. That is literally the only way to validate your MRR potential before you spend a single dime. You have the blueprint, but will you take the first step? The map is drawn. The vital signs are defined. You have the ultimate blueprint to build a highly successful SaaS business in the US market right in your hands. But, A blueprint left sitting on a desk never built a skyscraper. So the real question is, are you going to keep admiring the architecture, or are you actually going to take that first step and break ground? Get out there and go make it happen.